Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Brenneman, and this is the Brenneman Blueprint.
All right, we have a return guest today, Tom Panos, commercial insurance broker with BKS, an insurance brokerage firm. He's back on the pod. Welcome, Tom.
Good morning, Drew. Great to be back and to chat a little bit about the wonderful topic of insurance.
Yeah, and so we just recorded like an update, like a state of the market podcast, what's going on the last 12 months. So definitely check that out. And what's going on kind of like today, like current events, state of the market today. So definitely check out that episode if you haven't. And I had a bunch of questions to ask Tom and get into. And then the market's been so challenging, to be honest. We basically, we did a whole episode just on all the crazy things going on in the insurance market. So, we're back here, and this will be more of like me asking some questions. Most of all stuff for the most part I already know about, but we haven't talked about. And when we this is like in the weeds insurance stuff, but if you're a property owner, this will be probably could be explanations for stuff that you might see on your policy or somewhere, but not maybe never thought to ask about. And everything's going more and more important with insurance. But anyways, just real quick, if anyone hasn't saw it, Tom, what do you do for folks?
Yep, I'm a commercial insurance broker. I do accounts nationally, anywhere from real estate to nonprofits to hospitality, those kind of accounts, anything from property and liability and workers' comp and directors, officers, all the coverages any business would need to operate their business and protect their assets.
Okay, nice. And do you have a favorite client? Just curious. No, I'm joking.
I think it's called Brenneman. I don't know.
Yeah, no, I'm just joking.
I got to be careful, right? Depending on which one of my clients will watch this, right? So
no, I'm just goofing around. Tom's my insurance agent, is why I was saying that. So, but I think what I wanted to know, because it came up when we were talking about doing another episode, you had some people contact you that heard the first podcast that we did a couple years ago, and they'd send you like what their schedule, their policy, like here's the coverage I have, and then on this one you're telling me about, it's like here's like a couple things, boom boom boom, like these things we need to you really would want to change. So maybe let's and not this one example in particular, but just in general, what would you say are like the most either common or biggest, whichever way you want to take it, mistakes you're seeing people make with their insurance coverage?
Yeah, I think there's a few that I see. One of the bigger ones that I see is having really low building limits or limits that particular carrier will allow, and then having coinsurance. So not to, try to get in a whole coinsurance conversation, because people love that. Not really. But let's just say that if you're underinsured and you have a loss, again, if your replacement cost at a building is $10 million and you're only insured to $5 million, you have a 90% coinsurance or 100% coinsurance, that means you're supposed to be insured to 100% of the replacement cost. If you're only at 50%, there's going to be what they call a coinsurance penalty. So, and I see that a lot on that, and the insured doesn't necessarily know what that means when they just see coinsurance 80%, because you see coinsurance on like your health insurance, and it isn't, it's pretty standard where in our real estate insurance, what probably 95% or more of I'll have what we call replacement cost agreed amount or coinsurance waived, which means that if there's a loss, they're not going to do that coinsurance calculation. In other words, they're not going to say you're only insured to 50% of the replacement cost, and hence we're going to give you a penalty on that loss. And so that $500,000 loss, we're going to give you 250 now, right? What ours means is that say you are insured to that 5 million and we have agreed amount and a carrier has accepted this as the replacement cost, they will pay up to the 5 million without a coinsurance penalty for any loss. Now, again, the problem with that being is that if the whole building goes down and the true reconstruction cost is 10 million, you're still going to be underinsured. They're not going to give you $10 million because you're only paying for 5 million, but you're not going to get a coinsurance penalty, for say the smaller loss. So that $500,000 roof loss or what have you, you're not going to get penalized for that. They'll pay the full $500,000 on that particular one. So coinsurance, I see a lot that people don't understand. A lot of agents can't explain it. And so that's one that I see a lot of. I see wind hail deductibles a lot that people don't understand, that it's a percentage of the building limit, not a percentage of the deductible or a percentage of the premium or a percentage of something else crazy. So again, on that, that $5 million building, if you have a 5% wind hail deductible, is 5% of that $5 million, not any other number. And so it's a high number. So as most insurers would say, I really don't have any roof coverage, right? Because it's so high, you're never going to get above that limit for the most part. So, and so that we see a lot of that on there. Water backup is another big one. Water or sewer backup. We see a lot of those claims, and sometimes we see very low limits or no coverage, again, because it's not usually a standard coverage. Sometimes you'll see it in an extension form. Sometimes it's just not there. And so water or sewer backup is something that you want to definitely look at. Equipment breakdown, depending on the type of building you have. If you have central cooling and heating, equipment breakdown is important coverage, can be very expensive, again, if you don't have equipment breakdown coverage. So it's kind of like the ancillary coverage, if you will, not something that's standardly included that people are missing or not seeing or don't know, because some building owners wouldn't even how are you going to think about that when you're looking at a policy, when it's in your quote, go, oh, Tom, I don't have equipment breakdown on here. Well, I see it as my job as the agent to give you all the coverages and to do that. Not everybody looks at it that way.
Right. Even as you're explaining coinsurance, I was like, I don't even know if I remember how the calculated, but it's because unless I'm mistaken, I don't have that on any of my.
I was going to say, yeah, you don't have to worry about that because all your properties have a agreed amount of coinsurance waived. So that's why we've never really had a long conversation about it. Because like I said, 95% of what I write is I try to get rid of it because it's never good when you have a loss to have it in there for the most part. You know what I mean? Unless we're trying to specifically do that. And then we're doing that with our eyes open and going, we're only buying this limit and we have to because of the rate and where the building is and the losses and everything else. And that's the only carrier we can get. That would be what I would say the policy for me of last resort to have coinsurance.
And the way coinsurance works is, let's say, just for easy math, you're underinsured by 50%. So it's a $5 million building limit is what let's say you purchased, but your building replacement value is actually 10 million. So then they'd do 5 million divided by 10 million. So that's 50%. And then let's say you had a $2 million claim. They would say, we're not going to pay out the whole 2 million because you haven't been paying in the right amount of premium, basically. So we're going to take the 2 million, multiply that by the 50%, ratio here, and you're going to get 2 million times 50%, 1 million is the max we'll pay.
Similar to that, it depends on what the coinsurance requirement is, right? If the coinsurance requirement was 80%, then they'll do that ratio on 8 million versus the 10, right? Because you only had to be insured to 80%. So the calculation will be a little bit different. But the coinsurance could be 80%, it could be 90%, it could be 100%. So in your situation, the number you just gave, if it was 100% coinsurance, then yes, it would work that way. If it was 90 or 80, it'd be slightly different.
Okay. If it was 80%, how would it work? I know this is the episode to just get in the weeds. So
now you're making me do math.
Okay,
Drew.
The math's going to be too hard.
So that means you would have to be insured to a minimum of $8 million. In this case, you were at $5 million. So whatever that ratio is, that's what, 40% now?
5 divided by 8?
Yeah. So,
yeah, I think so.
Something like that. So it'd be more of a 40% penalty than a 50%.
Okay. Yeah, that makes sense. Okay. Yeah, that's so just more or less though what you need to know as the insured about coinsurance is don't unless
try
you're
to get it waived.
strategic.
Yeah.
And it's
most carriers will do it if you ask or negotiate it as a broker. And I just see it so many times that I don't even know if agents understand it or are doing it on purpose or what, but I see it in so many policies that I'm just like, get rid of this, have it waived and that sort of thing. And so what we'll do is do that. And, our goal is we're probably going to have to increase the building a little bit and still get a better rate and give them a better overall premium, as well as getting rid of some of these, what I call, unknown gaps in coverage that they don't even know they have, that unless you've had a loss, which, most people I talk to, I haven't had a loss in 20 years. I haven't had a loss in 10 years, or I just had a small little, loss. But when they have that one and then they get hit upside the head because instead of getting, $2 million or getting $1 million, that's a hard lesson to learn the hard way, right?
Yeah. And I would think, it would be, it's hard to say like, okay, you have insurance, but like, don't use it for like a small claim because it's going to have such a big impact on the rest of your stuff. But I did buy a building relatively recently where, it was a 8-figure, value building. And it was, there was claims for, the 10,000, 20,000 on there, or it was like, and after paying your deductible, if it's 5,000 or 10 or whatever, I remember thinking like, well, they really probably didn't like collect that much on this. And now you have I think they had 2 claims on it. And, it was like a water backup kind of thing where it was, it's hard to have a rule of thumb, but like, what are your thoughts on that? Cause it's hard to say like, yeah, if you're paying all this money for insurance, but don't use it. But it's, it's like it's so small. What are any thoughts on that?
Yeah, I try to take a consultative approach with my clients and say, hey, call me, let's discuss it kind of thing. And each one is distinct and separate and different, right? Depending on what it is and that sort of thing. Is it a GL claim where we don't know how injured the person is, or is it a property claim where maybe it's more finite and we know what the loss is going to be? And then I always say, I'm not here to put my hand in anybody's pocket. If you want to make the claim, we'll make the claim. I'm here to consult and give you my opinion and based on knowledge of the marketplace and doing this every day, what I'm seeing when you have, 7 claims on your losses versus none, and what you're going to get and how much you're going to pay versus, that. So that's where I think I could bring my experience and my knowledge and expertise in to have that conversation with you. And ultimately, you'll have to make the decision. I'll be like, Drew, based on that, what do you want to do? Do you want to make the claim? You'll only get $5,000 or you'll get $20,000. Is it worth it? Because now we'll probably get dropped because we've had 2 other claims. And so now we're going to have to go to a different market and it's going to cost you a lot more. Does it make sense for that $20,000? And that's I always say a Drew decision, not a Tom decision. My job is to illuminate the factors and facts and give you the opinion of where we're at. And ultimately then the insured has to decide what's best for them.
And then I think kind of along that lines, and maybe this is something you need to stay like neutral on, kind of like Switzerland maybe, but why don't you, maybe if you could tell us what's an insurance adjuster, and then what your any thoughts, or if you recommend people use them, or tell
you mean like an independent adjuster for a claim that would be like an advocate for the insured, or the adjuster from the company side?
Oh, okay, yeah, of course, yeah. I assume from the client perspective. So let's say I have a loss, and then you're going to submit your claim. Then the insurance company is going to send somebody out, and they know how everything in the policy works. I remember I had a fire at a building, and the stove that caught on fire, it was say it's like a $600 stove, let's say, and the guy he's like, it doesn't need to be replaced. It's like the thing caught on fire. He's like, you just need to change the top part
just
with
clean
the motherboard.
It up. Yeah, clean it up.
No, it was a repair. And I was like, this is crazy. Like, can you just give me a new stove? The whole building caught on fire. Like, this seems like a weird battle to have.
Weird place to draw a line. Yeah, that's weird. Yeah.
No, but but then he also knew the policy, and I think he was like, but things like it's actual cash value, so you're just going to get like $200 anyways, or whichever one's a depreciated value because this is an old stove. So he's like, either way, you're just going to get $200, doesn't matter, and or like give or take. And I was like, this is crazy if this is how it works. But so an adjuster would have they wouldn't, this is like a small thing, but if let's say it's a bigger claim, $200 not worth probably battling over, but the adjuster would review your policy, understand how all these rules work, and then advocate for you. And the thought is to get like I'll just say a higher, amount of insurance proceeds to cover like let's say the cost they're viewing as valid. Like you don't want to say it as like they just up the payout. You still have to use it on the building. It has to be all legit, but
right. Okay. So a third party adjuster. So yeah. So as you said, you have a claim, the carrier, has an adjuster on their side working on their behalf, good, bad, or indifferent. So like you said, some will battle you about that. Some will battle you about the little stuff. It depends on who you get and what it is. And sometimes they'll use an outside company as an adjuster. But having said all that, that's on the carrier side. But on your side, if you're having what I would consider a larger claim, say $500,000 claim or something, I think it's worthwhile that we, tell our clients it might make some sense. And we have certain people, there's good or bad, third party adjusters that'll work on your behalf also. And so we would have some we would recommend that you talk to that they'll take the policy, they'll go through it just like the company's adjuster is and understand the coverages and they work on your behalf. Of course, they get paid a certain percentage, say 7% or whatever that number is of the claim. But they're working on your behalf to make sure you're getting all your due on that claim. So they'll do like a business income calculation on your loss. They'll do, losses on, like you said, whether it's a stove or if they want to give you X amount for drywall and it should be Y, they'll negotiate that with the adjuster with their expertise, because they also have data and expertise in reconstruction costs and estimates. Because when the company adjuster does an estimate and gives it to you, Drew, and goes, hey, it's going to be $50,000 to repair that unit that caught fire. And you may not necessarily know all those. You'd have to go out and do some research or talk to a contractor and do all that. And it may or not be a good number. And then you have to try to negotiate that where they'll do all that on your behalf. And they have the data and the programs to run their own estimates. And sometimes they'll even proactively provide those to the adjuster and say, here's what we believe the claim is worth, kind of thing, and kind of prove it out with their information, which obviously an insured wouldn't necessarily be able to do.
And then they're using like a similar software almost to the...
Yeah, they have similar software that the other adjuster would use. And, like anything else, depending on what you put in, you'll get different parameters out, right, on construction, whether you're putting length or whatever quality you want to put in of drywall or thickness or, and I'm just talking drywall. There's other parameters in place that would need to be put in there. There's overhead and profit. There's all kinds of things in there. So for the contractor, so they work hard on your behalf. And like I said, on a smaller claim, it's there's no value there, because if you're going to pay 10% out of a $10,000 claim, what are you getting, right? So versus now if it's a $300,000, $500,000, multi-million-dollar claim, then definitely you want somebody working on your behalf, because that's going to be a longer term thing too. So the calculation for loss of rents or business income or other calculations, whether it's ordinance or law or any of these other things, they can calculate for you and work on your behalf rather than trying to do it yourself, because claims are difficult to do on yourself when they get that large.
And then, so you, based on that answer, I mean, you think they pay for themselves?
Again, for the larger ones, yeah, we believe that it not only makes it easier for you and to administer, because you still have to run your other buildings and your business and whatever else you're doing. You can't go full time on that. Well, they'll work on that for you. And so we find that they definitely pay for themselves, and people are happy that they did that, because they can get those extras, if you will. I keep talking about the loss of income, but other stuff as far as cost of reconstruction. And so they definitely would pay for themselves if you got a good one, right? Again, there's good, bad, or indifferent ones in that perspective too that are out there.
Yeah, because the way that claim I was talking about went with the fire, where I did not have an adjuster. It wasn't nearly a $500,000 claim though. And you get a number, and then it, if it looks good, then you probably don't bring it up. Unlike for that part, like, hey, maybe this will come in even cheaper. I don't know. And then the ones that seem low, you go, hey, this seems low. And then the guy would say, okay, go get a quote. then you know how it is getting quotes. You got to call 8 people to get 2 or 3 to show up, and then one of them only writes a quote. So that is where I spend a lot of time, was to get the quotes needed to get it up price wise. But then at least at that point I thought, well, now I have someone to do it, and the insurance company agreed they'll pay that. So now I'm done, where if I had the adjuster, I still need to go find someone who can get it done in that amount. I guess you'd feel, pretty confident you have the correct amount.
Yeah, definitely much more confident, and they'll get everything that you're due in a policy, which you may not ask for, and the adjuster may not, just bring up the give to you, is from that standpoint on what you're doing that policy. Again, I'll go back to the income portion or other portions of the policy where it says you're due X amount, whether it's in an extension endorsement or something else for a water backup claim or something else like that. That you wouldn't necessarily know or ask for, and the adjuster may not offer it up, and so that's where the third party adjuster, again, would be very helpful, because he's the first thing you do is they send me a copy of the policy. They're going to look through that with a fine tooth comb and get everything that you're due. And again, most likely more than pay for themselves, as well as, like you said, making the administration and the time involved and you working with that claim much less.
Yeah, it makes a lot of sense. And then let's talk about the types of construction, like I guess specific maybe to kind of some of the stuff that I saw in the last year, where, so we bought 2 buildings last year, and if the average person, or even not the average person, even me looking at them, they look like they're built the same way. Same type of construction. They both have indoor parking, brick buildings, same amount of stories. And on one of them, the insurance was almost half as much as the other. And so if you want to walk through like what happened, and there's something for people to be aware of, because I'll say, at least from the owner standpoint, like my takeaway on that is it's really difficult in this insurance environment to just assume like, okay, in this market, it's like in Chicago for a while, we had been just using $800 a unit as our insurance number. And, I don't know, probably 75% of the time that was like spot on. And it was almost seemed unnecessary to email you to get a quote and be like, where are we coming in at on this? But then every now and then you get one and you're like, it's the current owner's policy is $1,300. Like, why a unit? Why is that? And then it's things like this, or it's a podium building. So let's walk through those 2 deals, the difference last year, for people, just to kind of, this will be hard to remember, but more just to understand these little nuances then change the policy a lot. And you got to have your insurance broker be looking at it early.
Yeah. So those 2 were interesting, because you're right. If I looked at them online or the offering memorandum or stuff, I'd look at them, they look like the same construction from the outside, right? What we were able to do, though, is we actually found out who the actual carrier was, the incumbent carrier for the previous owner, and they had inspected the building, and so they knew the construction of those buildings. And the difference was, one was, although it was brick on the outside, it was frame, wood floors and wood wall framed, and the other one was block walls and floors. So one being what they called masonry non-combustible, and the other one called joisted masonry. And so the rates for joisted masonry are higher than they are for masonry non-combustible, for kind of obvious reasons, right? The masonry non-combustible, the fire will probably be contained in a unit, won't spread as much as, through concrete block walls and floors versus, wood framed floors and walls. The fire could be, cause much more damage or higher damage. And so the rates were, like you said, about half, much different. The replacement costs are slightly higher on the masonry non-combustible buildings than the joisted masonry, but the rate makes such a big difference that it became that big difference, because those were pretty, about the same size buildings, square foot wise and stuff. And the other thing I caution people on, the per unit cost, and I know a lot of real estate investors look at it that way, where we look at it more on a square foot replacement cost basis, because sometimes units are bigger also, right? So you could have a bunch of studios that are 700 square feet, or you could have a bunch of 2 bedrooms that are 1,200 square feet, and you have the same number of units. So the size of the building varies And so sometimes we'll see that vary. And when you take that and the construction difference, then it could, be a significant difference in the cost per unit per se for insurance versus looking at it in a different method. And then you mentioned a little bit about podium. That one is becoming more and more difficult and pricey because there's simply some carriers that just won't write podium construction. And for those that are wondering what we're speaking of, podium being where the base, the first floor is concrete or concrete block masonry, and then above that it's stick built. And so what the carriers are finding in losses is that if there's a fire in those, the heat is reflecting off of that masonry on the first floor and causing larger losses on those. So some carriers, if it's podium construction, are simply going, nope, we've had bad experience, we won't even write them. And so anytime we're limiting our market on who's going to write a particular building, the other carriers know that, and then the pricing is going up, and it's more difficult to get a carrier to write that building. Even if it's newer and or sprinklered, they don't care, they won't write it. And the other difference being is people are saying sprinklered, and a lot of times I'll say some carriers will only write if it's NFPA or 13, and some are NFPA 13R, and I'll speak of the distinction here in a minute. The 13R stands for residential, and so that's a life safety standard. So that means they're trying to get people out of that building safely with the sprinkler system, and that is a less expensive system to install. NFPA 13 is a system, more of a commercial grade system, so that is not only for life safety but for property preservation. So why do carriers like NFPA 13R? Well, of course, because it's going to help preserve the property, not cause all the damage to the building itself, as well as get people out safe. So again, on some buildings, we'll ask the question, is it 13 or 13R? And then again, that could vary on whether that's going to help us with the carriers or not, 13 being the one preferred.
And then on the one that's also for building preservation, does the water turn off?
Yeah, I think when the fire's put out, there's sensors in there that it turns off and stuff and that sort of thing. So yeah, there definitely is. Now, we also have claims for sprinklers in buildings, right? So you have freezing pipes, you have all kinds of things that could happen with sprinklers too. So it's not the be on end all, but certainly for the most part, carriers look at it positively and you either get credits or they'll write a building, especially if it's 4 stories or more. A lot of them are now requiring or wanting a sprinkler building. So it's hard to write a high rise nowadays without any kind of sprinkler system in it. And most of the standards are requiring that when they're being constructed now. If you have an older building, a 10-story that's non-sprinklered.
Yeah. So yeah, real important to try to get, find out who the current carrier is, get a loss run from the current owner. And then, which if people don't know what that is, that's like a schedule of any claims they've had, and try to go back as far as you can time wise. And then, because then that info, you can help your broker go through and understand what's at the property. I mean, the reason we figured out all that construction stuff on those 2 we were buying was because the carrier they use is actually the same one we would use for that type of property.
Yep.
So then you ask them, like, how come you have these 2 rated differently?
And they told us about the construction, yeah, and it's good to get the loss runs too. So we're seeing that a lot more, and that's a really good point, Drew. Is that a lot of the carriers now are requiring them, and so if you're looking at a property or buying one, ask for the current carrier and get the loss run. We call it currently valued loss runs. That means a loss run. It's a list of your claims for X number of years. So if you've owned it 5 years, get 5 years, especially if they look good, right? If you've owned it for 3 years, get 3 years of loss runs valued. And the valued means when they actually ran that report. So currently valued would be within the last 90 days of whenever you're asking for it, the carrier will accept it. So what we do, especially if they're clean, is I can take that information then and know who the carrier is and maybe talk to them about rewriting it or what have you. Because sometimes now, if they're not on it and you send it to them, they still might not write it. But if they're on it, I can maybe talk them into writing it, number one. Number two is, especially if they're clean, I can then use that and go, hey, look, building's been clean for 5 years, great building, and they're more apt, again, they being the underwriters of the carrier, to write it versus decline it. And altogether, some won't even look at it unless you have loss runs, period, regardless good, bad, or indifferent. So it's important to ask for those nowadays. And it kind of gives you an idea of how the building is run too, which I think is important when you're buying.
So some coverage that I see come up, and then I think for quite a while I didn't know what it was, and now I do. But the ordinance or law coverages, and then there's the different ABC. Let's run through.
Yeah, so that's important. One of the things we don't see, sometimes on buildings, your Freddie Fannies require this. A lot of the lenders don't require this, but Ordinance A is the undamaged portion of the building. So what does that mean? Is that, let's say that you have a building and 60% of it burns, right? And is damaged by that fire. 40% is untouched. The carrier owes you the 60%, the 60% that's damaged to repair that. Well, ordinance or law of that particular municipality may say, hey, it's more than 50% burned. You have to demolish and reconstruct the whole building. We're not going to let you just repair that 60%. So now, if you don't have Ordinance A coverage to the building limit, the carrier owes you for the 60% burn. The municipality, the ordinance is saying, no, you have to tear it whole down. So now you have that gap of 40%. And again, on a larger building, could be a lot of money, or even a smaller building. And so Ordinance A covers the undamaged portion that the carrier doesn't owe you unless you have Ordinance A coverage. And that city, or again, municipality is making you reconstruct that portion of it too. So that's that. Then B is demolition costs. So sometimes policies will have a small amount in there. They might have it in an extension endorsement, but B is a demolition. So again, demolition can get expensive. And for that undamaged portion too, they don't owe you any demolition costs for that. So Ordinance B could cover the demolition costs for that. And then C is for the increased cost of construction. So what is that? So now you have to reconstruct the building, but the code in XYZ municipality says you have to have hardwired smokes. You didn't have hardwired smokes. You have to have a sprinkler system. You have to have whatever that code is today to reconstruct that building. If you didn't have it in your previous building, the carrier doesn't owe you that. They don't owe you upgrades like that. So the increased cost of construction is Ordinance C, and that's what they would cover. The differences that the ordinance or law is requiring, that would be an increased cost of construction.
And then is there any insurance out there that would cover somebody, let's say they own a non-conforming building, so it doesn't meet the current building codes. Let's say it's built too close to the street, it's too large now for what the requirements are. Let's say you have a total loss, and let's say there's a city out there that won't let you rebuild it as is. They go, what you rebuild, draw it up, pull permit, but it's got to follow like today's standards. And you have let's say you have a building value loss, like it's what you can't build as many units, or it's smaller. I already think I know the answer, but is there insurance coverage for this type of loss due to the ordinance law?
No, there isn't. Unfortunately, there's no coverage for that. That's one of those uninsurable expenses, if you will. But what I also tell people in that situation, which we deal with from time to time, is, you don't have to reconstruct that building on that particular lot, right? If you have a loss, your policy says they owe you reconstruction. So if you own a property wherever, 10 miles away, that you can build that 12-unit building on now, instead of having to maybe cut it down to an 8 or a 10 or whatever to meet the current requirements or codes, you can build that on another lot. You don't have to build it there. So that's one option that you still have that you can do that may help you when you come to that. Or, if you're building a 10-unit, then, if it's newer, you might get the same value for the rents anyhow. So it just depends on where you are and what you're doing. But there's not a coverage, unfortunately, I can sell or add to your policy that would account for non-conforming type stuff.
But you could use the money to build the, let's call it the same property with the insurance proceeds on a different parcel?
Correct. Yep. Now, they're not going to buy that parcel for you. You'd have to own that parcel. But yeah, they will. You can build it anywhere. You don't have to build it at that specific address.
Then similarly, let's say you don't own that second parcel to build on, but it makes, you can't rebuild your building, but it actually makes sense just to sell off the land now just as a development site for somebody. What would your insurance payout look, where they would just, say, here's what our calculator is spitting out for a full rebuild, and would they just cut you a check for that and say we're done here? Or
They would not pay replacement costs. They would pay what's called actual cash value. So that is replacement cost minus depreciation. So they're going to give you some sort of depreciated value. So normally the way a claim would work in simple terms is you would start, constructing or what have you, and they'll pay you up to the actual cash value. And then once you've completed and can show them that it's completed and that you paid out X amount, they'll pay you the full replacement cost. So you could collect the actual cash value and just, like you said, sell that off to some other developer and not reconstruct and get the actual cash value.
But usually there's quite a bit of gap there between replacement cost and
it depends on the age of the building, this, all how updated it was, what your records show on how updated it was, and what you can show as far as that building and what is depreciated. So a lot of our brick walk-up type buildings in Chicago, for example, are pretty old, right? They're built in 1920, and some have been updated, some have not, and so the depreciated value is going to be pretty low versus a building that maybe was just built on some of your newer ones that were built in 22 or 23, and so you don't have much depreciation in those buildings because they're just not that old yet. The roof isn't 15, 20 years old, the plumbing isn't 20 years old, and they're not going to depreciate all that.
Then just keep going down the questions here. So Stab-Lok panels, that comes up. I bought a deal a couple years ago that had those. What tell us about those?
Yeah, so Stab-Lok panels were used in the 60s and 70s, I think they were a less expensive panel, and when they were trying to cut costs, you see some aluminum wiring in some of those buildings in the 60s and 70s in certain parts of the country, and the reason carriers don't like them is there's a lot of data that shows that they get hot and they start fires. And so a lot of the carriers, I think I maybe know one, maybe two that'll accept them, maybe, depending on where they are. But for the most part, I'm going to say 99% of the carriers will not write Stab-Lok panel buildings. And so that's, becomes a difficulty if you have those and you don't have circuit breakers. So sometimes we'll be able to work with the carrier and go, hey, they have Stab-Loks, but they have quotes, and as soon as they close, they're going to replace them within 60 days. And sometimes they'll accept that. And sometimes they'll be like, all right, well, then call me after 60 days and we'll talk about it, and then we have to do something, in between, or find the one carrier that'll write it, but that carrier is going to be much more expensive. It'll probably be what we call an excess and surplus market that will allow it, but their rate is going to be much higher. So again, be cognitive of what you're buying and what kind of electrical systems it has. Circuit breakers, definitely no fuses. Stab-Loks are almost as bad as fuses now, and aluminum wiring. And so, I think that, again, looking at construction like we talked about, whether it's podium, and then, you won't see, podium is kind of a newer construction. You won't see Stab-Lok there, but if you had a podium Stab-Lok, you're going to be uninsurable.
What if it's in Florida? Is that better?
Strike 1, 2, 3, you're out. You're definitely uninsurable. Near the water in Miami, right? Okay.
Yeah. It's on the water. It's it's flooded a couple of years ago with that one storm, but it's fine now.
That's an interesting topic to bring up. I was just down there and I was talking to some people about real estate, and the buildings that are really suffering down there are the older condo type buildings that aren't updated, that aren't up to hurricane standards, that are having real problems. Obviously, we had the collapse a few years ago, and now with all the convective storms and all the losses we're having, their insurance is going through the roof. Especially on those older buildings that aren't built to certain standards. And these people, in these units, can't afford it, but nobody's going to buy that building either. So they have a real problem down in Florida right now in some of the condo type buildings that are older. So, and I'm guessing maybe some of those have Stab-Loks and aluminum wiring. And so the insurance is looking at those and going, oh, man, or they haven't updated the roof. That's the other thing, is the age of the roof is another important factor, whether it's in Florida or in Chicago. When a carrier is looking at it, they have a lot of data nowadays that they can access and that they're relying on. I mean, we have one carrier that uses AI, and they won't even tell us the proprietary algorithm, but there's like 20 factors they look at, that they get data from all kinds of sources, and then they decline or write certain accounts based on this data. And then we're like, well, what was it? And they can't necessarily tell us. They won't tell us what it was.
Yeah, that is. And then on aluminum wiring, now is that at this point pretty much uninsurable, or what's?
Yeah, well, it has to be redone, and I believe certain way that it's wound or redone that can become acceptable. But that would be something that would have to be done, and there's a cost associated with that. Put into a new panel and rewound or wound properly or whatever.
Yeah, I've had that explained to me, so that I know a bit about, where you need to somehow connect the aluminum wire at some point with a copper wire, and again, then somehow it's connected, and as I'm explaining this, I'm like, how is that not a failure point? But I didn't study engineering. But that gets connected to the panel.
Yeah.
So I was told that's fine.
I believe it's called pigtailed is the word that we're looking for. So.
Yeah, but it was at one of these deals where it was like, brokers walking you through and like, they already handled it. They already, pigtailed it with copper. Everything's fine here now. And so that's because everyone's coming through like, what's the wiring like? It's from the old building.
No, that's all relative stuff. And like I said, the Stab-Loks, we've been through that with you, and I've been through that with others. Actually, I have one building now that has them, and it happens to be only one panel in this large building that's in the hallway that they're going to allow them to replace. But if the whole building was this way, then we'd have a bigger issue.
Yeah, and then I think let's this. For getting an insurance certificate, this is something that sort of blew my mind. Maybe we should have started this instead of having at the end. But they, what's the proper way to receive one? If that makes sense, or I could ask it differently.
So I think what you're saying is what do you request and how to get one properly done?
How to review it, I'll say, because I guess I'll explain what I found out, and that'll make more sense then. So okay, everyone, they ask for an insurance certificate. You're going to have, your roof replaced. You say, hey, send me an insurance, or I want one from the contractor. And then, you check it. It says they have insurance. And then, and you see that your name's listed on it. And then you think, okay, that's fine. And it says on the insurance cert, it says, as per written contract. And most people receiving the cert don't have a written contract. So what surprised me with getting insurance, or let's say in this roof example, is you get the insurance cert. It just says they're an additional insured or whatever covered in this policy per written contract. If you don't actually have a written contract with that roofer that says they need to provide you with that insurance, do you have coverage or not?
You are not additionally insured. No. So that is a really good point. So so there's definitely certificates from subcontractors. Now I know what you're talking about. So if you're having somebody do work, yes, we highly recommend that they're insured, and they name you additional insured on a primary non-contributory basis, which I'll talk about in a second, with a waiver of subrogation, which again I'll talk about in a second. So, but then there could be language on there in the comment section that says, as per required by written contract. So a written contract is just that. It's a written contract, but sometimes it could just be an email or a note. And that's what I tell people. It doesn't have to necessarily be something, that's documented. It's just something that you both have signed. So you can have a note that says, hey, you're going to name us additional insured, primary non-contributory for this project, Joe Blow. And then you sign and he signs that you have a written contract. So it could be that easy, but people aren't doing that. So they get this, and it's great. It's a piece of paper. It looks wonderful. It says, you're additionally insured. But when you read that section that says when required by written contract, and then you have no written contract at all, you're not additional insured anymore, And so that, being additional insured on a certificate or on a policy gives you rights as an insured versus just, being an insured. So not an additional insured. So yes. So what primary non-contributory means is, with the language, is a certain type of additional insured endorsement a contractor might have. And that means that their insurance is going to be primary, and your insurance is not going to contribute towards it. So they're going to cover the entire loss. That's what primary non-contributory means. Because they could say, well, we think we're 80% at fault, and so they try to recover the other 20% from your carrier for whatever reason. These things get, carriers try to save money, right? When they're adjusting a claim. So that's why we want primary non-contributory, and then waiver of subrogation being that they're not going to try to come back against you and subrogate, which means recover from you or your carrier for that loss. So that's why we like to see that language on there. And again, for a lot of our insureds like yourself or others, I'll give you like a sample certificate and you try to match it up, or I say, send me the certificates and we'll take a quick look at them and let you know that it says this. And my first question is, do you have a written contract? That'll be my first question. And then, if you do, then all the stuff we have on there that says additional insured and all that. And sometimes you can't get primary non-contributory in that because they don't have that additional insured. Again, then it's a due decision on whether you want to work with that contractor or not. Some people are like, well, what if they're not insured? Well, then they don't have insurance. You're not covered. So if they, damage something, which is to be their general liability or what have you, they're working and they break a sprinkler pipe and now the whole building is flooded and they have no coverage, you got a problem, and so hire insured subs. They might cost a little bit more, but my recommendation is hire the proper people and make sure they're insured and have the right additional insured language on your certificate. And that would cover you.
Yeah. And I'm not an attorney, so I could check with your attorney with what I'm about to say. But what I did was I made a one page. I just opened it. Exhibit A, insurance required by this contract. And then it lists out what you need. This says required coverage, comprehensive general liability, 1 million per occurrence, 2 million aggregate. And then we just go down what workers' comp they need on down the line. And then in the actual contract, I write in a phrase like, cause let's say the contracts I get sent, I don't know about you, Tom, but they don't say they'll provide specific coverage. They don't say anything usually. Right. So then you need to add the contractor will provide all insurance as listed in Exhibit A, and then both people need to initial it, you Absolutely. And them. Yep. And then they sign the exhibit. So I just, whatever contract I have, assuming it's fine, you don't need to rewrite it as well. You would add this exhibit to this is, let's say it's a 1-page contract, then this is page 2. And insurance then I have the coverage now.
Perfect.
Because I tried doing it without the exhibit, and you'd be banging your head against the wall trying to have the same guy who's going to do your roof also write his contract. So you want to just say, hey, I signed it, but I added our insurance exhibit, so sign that to an initial the thing I added, and then you're done. So you should just write this 1-page thing, and then if anybody wants to see it, send me a message. But which I've ended up sending this out to a couple people that just more like buddies when I explain this. We're like, that's great, and then but I don't want to rewrite.
I know we worked on that together on what you should ask for, and umbrellas too. You were asking for 1 million, 2 million, and then you're like, how much of an umbrella? I'm like, well, what are they doing? How much damage could they cause, right? Because liability is bodily injury or property damage. So they could hurt somebody or they could cause property damage. And, if they can cause more than 1 million per occurrence, then we want to have an umbrella. So a roofer or somebody doing something structural or what have you, we're going to want a higher limit than a guy painting, for example.
Yeah.
Those are important to know.
Yeah. And then in this thing I have certificate requirements. This is what you had helped with too, where it says they need to have describe the certificate holder is listed as additional insured on a primary and non-contributory basis with a waiver of subrogation in bold and underlined. I have it. So then if they don't send you that with that language, then it doesn't meet what you have in your contract.
I think it's helpful for contractors too, especially the small ones, Drew, is that when you give it to them in that manner, which you were describing, it's helpful because they can just flip it to their insurance person, because these guys are contractors, right? They don't necessarily know what all that means either, but they normally have it. And if they can just flip that requirement to their insurance broker, then they can come up with a certificate and give you the proper coverages too. And I think that's helpful.
Yeah. And then I think the last thing to touch on then is, let's say, because this is something that I used to do, and as I got larger into our portfolio, I had to stop. But let's say you manage your own properties and you get a maintenance guy that you just pay per hour, and you find them on whatever the modern version of Craigslist is nowadays. I'm not even sure where they are, but you find them, and then you're paying them by hour. And there's no benefits or anything. They show up, they do a repair. They say it was 3 hours, so I need $90 or $30 an hour. And then what happens if that person were to get hurt, and they couldn't work? Let's say they fall off a ladder at your property. I know you're not an attorney, so obviously what is the potential exposure you may have?
Yeah. And it varies by state. I'll start with that. But let's just talk about the state of Illinois where we are, which is a very tough state for workers' comp and expensive. So, one, again, we want to look at the certificate, and hopefully that subcontractor or this individual that you're hiring has workers' comp. But a lot of times, let's face it, like you said, you find him somewhere, he's making $30 an hour, he doesn't have workers' comp, he's just coming out and doing a little job for you, changing bulbs or exit signs or whatever he's doing.
Just to jump in, if you are working yourself and you're that person, can they even buy a workers' comp policy on themselves, for one?
Sure, they can buy, a handyman or various carpenter policy or whatever their type of work they're doing. So yes.
Well, that's important to know the answer to that, because I will guarantee you, from my experience, they'll say they tried, they can't. I don't know how,
get one,
or I don't have the money.
Yeah,
that's why they don't have it. They
right.
tried.
They'll probably be in like the state pool, which will probably be like $2,000, and they don't want to spend the money, right? And deal with that. But they can get it. It's hard to get a direct carrier, anyways. But so that person, while working for you, gets injured again, changing light bulbs, up on a ladder, falls off, gets injured while working for you, and doesn't have workers' comp. Especially in let's talk about again the state of Illinois. That person would be, if you had workers' comp, which you, again, as a building owner may or may not have, would be covered under your workers' comp, or then you have now an uninsured liability where he's trying to get money from Drew or whoever the building owner is because he got injured while working for you. You don't have workers' comp. So if you carry workers' comp, it'll pick that person up. But again, is that workers' comp carrier going to be very happy that you're hiring uninsured subs? No, of course not. But definitely have your own workers' comp, or make sure that they're covered because you're responsible for them while they're working for you. If they go to, Bobby's building down the street to do other work, you're obviously not responsible for it. But when they're working for you, then yes, even as a 1099 is still considered working for you. Again, at least in the state of Illinois, other states are not as liberal with the definition.
Yeah, and so I think that's what I just want to end on is, if you, let's say you're a smaller landlord, especially because your example back is, potentially assuming a scenario where you have your own workers' comp policy that maybe could step in, but let's say you don't have any employees, you bought a couple rental properties on the side or whatever, you just quit your job, odds are you don't buy a workers' comp policy on yourself if you're just sitting inside in the air conditioning, looking at deals on the computer. But then you hire the person for $30 an hour, and then you go, yeah, it's 1099. I just write them a check. They're not an employee. But what happens is, if they get hurt, it gets looked at by an attorney representing the injured person, and they go, well, really, you were a part-time employee for that person in this state. I know you're being paid 1099, but the guy told you to show up at 9 a.m. and you did, and work till you were done. You told him, hey, I was done at noon. You got paid for 3 hours. That's a part-time employee.
Right. They will contact what we call IDOL, the Illinois Department of Labor, and you'll get a nice letter in the mail saying that they've, had a complaint, and they'll find that most likely that he was considered an employee under Illinois law, and therefore you're responsible for the bodily injury. Yeah,
and I know we're saying Illinois, but I mean, I've looked into it.
It's other states too. Yeah, specifically, I know it's liberal, very liberal here. Other states, again, aren't as much, but for the most part, you're going to find the same thing in most states.
Yeah, and you will, because if you look at it just from a more neutral perspective, I know it's a real estate investing podcast, so this might not seem fair, the explanation, but like the person who owns the building, they have what appears like a lot of money, and this is like a worker who's out there per hour working, and now they literally have no source of making money. Let's say you broke your shoulder and you're a painter. I mean, why? I mean, that seems like, how else would it go? I guess is how I'll say. But let's leave it there, Tom. How do people get in touch with you? They want to learn more about this stuff or potentially get a quote on things. How do people get in touch with you?
Yeah. Thanks, Drew. So they can reach me one of two ways. Obviously, phone. My direct line is 847-940-4228. Or my email is Tom.Panos, Panos, at bks-partners.com.
Awesome. Thanks, Tom. Appreciate it.
All right. Thanks, Drew. Appreciate the time.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of